We've got 3 sections to the presentation today, but maybe we should have added a 4th. Let's just talk baseball for 15 minutes and we'll all get through it. And then we'll get on to the capital markets. But we all need to do that for a little bit this morning to absorb what happened last night. But let's move off of that happy time and get into the quarterly market report. I don't want to make things sound too dire, but it might be a little bit less joyous than how we're all feeling today after the World Series win. We are gonna have 3 sections of the presentation today, and the first section is the key themes for 2021. We'll revisit those and talk about the one we're going to focus on today. The second part of the presentation is the market recap, and the headline there is a recap about nothing. A somewhat obvious nod to the Seinfeld show, a whole show about nothing. And maybe this recap is kind of about nothing. Not that much happened in the last quarter, at least that was obvious. I will point out a few things that lead us into what I'm looking at going forward, the market outlook. And we're going to talk about more taxes that's being driven, we think, by more spending, but a lot of those details are still to be ironed out. So I'm going to talk about what the implications would be of some of the policy choices that are out there right now. So let's jump into the key themes. We began talking about these even before the beginning of 2021. In late 2020, we started to put these out there for folks because we saw a fairly clear path for this year. And that is very unusual for us. We often will say, well, it's hard to say what's going to happen in the short run, but the policy of the federal government was so significant and made it so clear what path we were going to go down that we felt very confident in saying, here's what to expect in terms of returns from the capital markets. And the first part of that was that all the monetary and fiscal stimulus really should help the stock market. And when we get to the returns sections of the presentation here, you'll see that indeed that's been the case. The next section is that public fixed income will suffer. And that too has happened. It's not that we necessarily expect negative returns, but very low returns. And when you're looking at returns from that part of the market, it's pretty appropriate to compare them to the rate of inflation. And inflation's been running in the mid-single digits, much higher than any of us is used to in recent history. But if you're making low single digits in your fixed income, but actually losing to inflation, those are negative real returns. The third part is extreme volatility at any time, and we haven't actually experienced that yet. Despite the headlines and the emotion that seems to be embedded in the markets have been relatively calm. As we said, in fact, this last quarter, very little happened. Then we say that tax rates are going to increase. That's the subject of today. And in the next quarterly market report, what we'll call our annual market report, we're going to get into more detail about how we think private market investments perhaps could play a larger role in your portfolio. So let's dive into the market recap, and we're going to move relatively rapidly here. It wasn't about nothing. A little bit did happen, but it was amazingly calm given what's at stake in the markets right now, and the fact that we think the valuations in the market are extremely dependent upon the policy of our federal government. Let's start with the BIP blended benchmark results. This may look familiar because you also saw that on your own quarterly portfolio report. We got those out in a very timely fashion after the end of the third quarter. So I'm hoping you've all had a chance to look at how your own portfolios did. But what you'll notice is that for the last 3 months, the fixed income index was only up 0.05%, which was not nearly enough to bring the year-to-date number into positive territory. In fact, the one-year number is negative 0.9%. So clearly that prediction of public market fixed income returns would suffer has been the case. If you look at the bottom part of that table, you'll see that the global equity index was down 1.11%, but that slightly negative performance for the quarter was not nearly negative enough to dampen the enthusiasm that we've had for the stock market. The year-to-date numbers of between 11 and 12% and the one-year number of up 29% has been very significant and has sent a lot of people's portfolio values far higher than they had expected they would go. Always like to show some of the headlines that might have driven the market during the last quarter. But in fact, we have one of those quarters where there was a lot of dramatic headlines, but not too much seemed to disturb the markets. Now, I put the ones in green that seem to me like they should have driven the market upwards, maybe the ones in red that should have driven the markets down, and then ones in gray where there's still more to come in about that. And the ones in gray have a little bit to do with some issues of the supply chain, which we're going to get into in more detail later on. But today is a good day to be delivering this presentation because there's a Federal Reserve meeting wrapping up today. We're going to learn more about that last red headline where the Federal Reserve is teeing up what we're going to call the taper. And that's the taper in their bond buying. I'll show you a chart to make that a bit easier to understand. And they've in fact signaled that rates may begin to rise next year. I'm not convinced that the market's really ready for that, but we'll go into the implications of what that might mean later on. As we break out the details of the market, again, there's not a whole lot there to look at in terms of this past quarter, but you may notice that emerging markets were down about 8%. That in no way compares to the downward volatility that we saw over the last couple of decades in a prior quarter in 2008 in Q4, when the emerging markets were down 27.6%. The best quarter for emerging markets was shortly thereafter when we saw a positive 34.7% return for emerging markets. And if you look at the downward volatility and then you look at the upward volatility, you'll notice some pretty extreme numbers that we haven't had to deal with lately. And those dramatic recoveries in all those parts of the market over the last 2 decades were really driven by policies of the Federal Reserve and to some degree by fiscal policy, the spending side of things as well. And I'm going to make the argument later on in the presentation that I think maybe the government has been giving markets too much help. And in fact, have kind of given us all a bit of a guarantee, if you will, as investors, that they're always going to come to the rescue. And I don't think that's sustainable, but it's certainly given us a great couple of decades and ones that we might not want to use as our benchmark for how things should work going forward. Looking at what happened in the US, we've got all these charts here and we're making a lot out of some pretty small numbers. Large growth did the best by a little bit. Small growth did the worst, at being down in the mid single digits. It might be more instructive to just look at the bottom right part of this slide and see that year to date, the best place to be by far was in small cap value. That's also the trend for the last 1 year. So I'm happy that that's a part of the market that we've overweighted. So our clients have been able to enjoy that extra performance from that part of the US market. Also of note, the US stock market is now 59% of the global stock market. Really hard to believe that with 5% of the population, we've gotten that big, and it just continues to grow. In many ways, what's happened in the U.S. has made us the envy of the capital markets all around the globe. Not sure that can continue, but it's just been amazing to see that the U.S. has become such a big part of the global stock market. Within U.S. developed markets, some things like small cap did a little bit better than others, like the large cap. Growth did just a little bit better than value. We show the returns in both local currency, which is the light gray bar, and US currency, which is how we all invest, which made things a little bit worse. So what happens is the dollar strengthened and those foreign currencies fell a little bit. So that's a little bit negative for US based investors. The currency you invested in to invest in those markets declined and took away some of your return. But there is good news there, and we'll get into inflation in a little bit. And the good news is that strengthened our purchasing power, and as inflation just seems to be taking off, any little move in currency that gives us more purchasing power was welcomed. And then moving into the bad news part of the market recap, we see that emerging markets was down, but there is a silver lining in there. We overweight small cap versus large cap. We overweight value versus growth, and small cap and value are the best parts of the markets to invest in. So really our investors did much better than this quarterly table in the top right would indicate. And in fact, if you look down to the 1 year column, you'll see that small cap was by far the best place to be over the last 12 months, and value did way better than growth. So that overweight to small cap and value actually protected our investors quite a bit during this past quarter. Getting into currencies a bit, we've got information that I always like to show. It's not so much that it was relevant to the returns that we got. It did affect things a little bit, but the message here is one where I think it's more important for what we talk about inflation here in a little bit. Our currency strengthened. So if you walk into pick any retail store, let's say you walk into the Home Depot and you're buying things with US dollars that in many cases were made overseas, that stronger US dollar means you can buy more of those goods. So that's disinflationary, anti-inflationary, if you will. Inflation is ramping up, but this last quarter helped us a little bit to not put up even worse inflation numbers. So if that goes the other way and the US dollar weakens, then that's going to make inflation even worse for us. And there's lots of reasons that currencies can move up and down. We could probably spend a whole presentation on that. But we got protected just a little bit. I don't know if that's going to continue because we're putting up some inflation numbers that you might have heard of just recently, such as that the Social Security cost of living adjustment for next year is going to be 5.9%. So clearly inflation is here. Moving into commodities, we could see the effects of inflation there. Despite our stronger dollar, natural gas was up significantly. Cotton, coffee, aluminum, a real mix of commodities that we use in industrial production, as well as commodities that are just part of the dinner table or other regular household use. For the most part, got more expensive. And over the last year, in the aggregate, that index has gone up about 42%. So you might look at that and say, well, that's about in line with what we've gotten out of the stock market. But don't think of it from the investor standpoint, think of it from the consumer standpoint. This basket of commodities, which is somewhat dominated by oil and gas and carbon-based fuels and so on, that's gotten 42% more expensive in the last year. Now we'll wrap up with the riskier parts of the market by looking at REITs and just being happy that we overweight US REITs versus international REITs. We do get exposure to both, but US REITs have definitely been outperforming. They did for the last quarter. They have year to date. They have for 1, 3, 5, and 10 years. So still glad we've got the international REIT exposure, but happy with our overweight to the US. Now let's look at fixed income for just a minute as we kind of wrap up our look back in time. And again, maybe a recap about nothing. The dark blue line that shows you the yield curve, that's the interest rate offered by the federal government for treasury bonds, didn't move much at all over the prior quarter. So in fact, it pretty much covers up the curve that shows where we were at 90 days prior. But it is higher than where we were at a year ago. And that's one of the reasons that the fixed income market has suffered. And indeed, that's part of what we had predicted. I want to make a further prediction now, or in fact, maybe it's just a warning that I think that we could have to adjust the vertical scale on all this to go much, much higher over the next couple of years. There's certainly reasons to believe that interest rates could shoot up quite a bit. So I'm not sure that these problems with public market fixed income are going to be cured anytime soon. Either we stay here at very, very low yields, or as rates move up, you start to see prices take a little bit of a hit. And you might notice that over the last 1 year, the index for investors in long-term government bonds is down 10%. And that's just a reflection of this minor movement upwards in interest rates. If that keeps going on, we could find negative years and even in the 20% range or in the near future, which is why at BIP Wealth, we don't invest in that part of the bond market. Well, that's the past, and we did go kind of fast and just showed you everything that's going on out there. Now we're going to slow down just a bit, and we're going to talk about what we're looking at in the future, because I think this is the most interesting part of the presentation, and I want everyone viewing this to feel they've been warned when we start to get some of the news that I think is going to come out here shortly, including even today due to the Federal Reserve meeting. So the first slide we're going to look at is just some evidence to prove that the economy is booming. And I'm not going to show you half a dozen slides about this. I'll just show you one to kind of prove the point. But this is a graph of retail sales. Now there's something kind of hidden in here, a hidden meaning in here that you might not notice right away. But if you were to hold this slide up to the one that I showed 90 days prior, you may notice a difference in those gray vertical bars. Well, the gray vertical bars illustrate when we're having a recession. And there are some groups that would purport to tell us when we started a recession and when we ended a recession. And 90 days ago, we were still showing in these slides that the recession was ongoing from the pandemic. And I was arguing that the economy was booming, and that was ridiculous. And in fact, the official word is now out. Our recession lasted 2 months. Just 2 months. We were out of the pandemic in 2 months. And if you look at this graph of retail sales, you'll see that after about 3 months, we had fully recovered. And in fact, retail sales are now way, way above where they really ought to be. And that is being driven by the policies of the federal government, the creation of money, all this stimulation of what's called the demand curve. And it's caused consumers to have extra money, borrowing to be extra cheap. And so with all these dollars in our pockets, we are just demanding more and more goods. And it's really overheating parts of the economy and leading to this inflation we're so worried about. Well, employment is booming as well. Now, if you're an employer looking for good people to be a part of your company's team, then it's getting harder and harder to find good folks. If you're looking for a job, it's relatively easy to find one. Always say that with some sympathy towards the people out there that might be looking for something and actually struggling. It's hard to read how great the market is for job seekers when that's happening. But the measure that we've shown here, initial jobless claims, has now moved below 300,000 for the week, which is sort of one of those round numbers for people that follow the employment market that's significant and definitely indicates that there's not that many people, again, on a relative basis, trying to find a job they can't get one. So now I'm going to spend just a couple of minutes on this slide. It looks a little complicated, and it is, but I hope I do a better job than my first economics professor that showed this to me. But this is supply and demand. And this slide really helps me to make my case that I think the Federal Reserve, and to some degree Congress and the White House, have been getting this all wrong really since the beginning of the pandemic. The nearly vertical line called S1 is the supply curve, and that just shows you what supply companies are willing to bring to the market at given prices. So when the price is high, they bring more supply to the market. When they can't get as much of a price, they bring less. Now, it's worth commenting that we have all become reliant on capitalism as a function within our world that solves most of its problems rather quickly. If I can dream of something that I want to buy, you know, the holiday season is coming up, maybe you decide you want a purple Christmas tree. You know, we've learned that capitalism is so reliable, we could go on Amazon or stroll into our local big box retailer and probably find what we're looking for. Capitalism as a function has anticipated that need. Someone's figured out how to make it. And if we're ordering it online, we're surprised if we can't get it delivered the next day. That's how good capitalism is at serving our consumer needs. But that has become broken. And so what's happened is that the supply curve has moved to the left. And at any given price, it supplies less into the market. Now that's a function of the pandemic, really. And numbers are getting worse in China as we speak. And so the supply chains are indeed broken. Well, that's to be expected, and that's somewhat normal. And there's policies that can help to fix the supply chain to some degree. But the demand curve has been moved potentially in the wrong direction. Nearly every policy that's been enacted by the Federal Reserve, or even on the fiscal side of things, has sought to increase demand. Well, if the supply is not there, increasing the demand probably isn't going to get the job done. But that's exactly what's happened. And it's been through some rather extreme policy, as I'm about to illustrate. And so demand has actually been increased. And so where supply and demand used to cross inside the green circle there, that P1 times Q1, price times quantity, was our gross domestic product before. Now we have the S2 and D2 crossing at a much higher price. So the economy has grown. That price times the quantity is the new GDP. But that increase in price is what we call inflation. And I don't think that's going away anytime soon, although I'm eagerly waiting to hear what the Federal Reserve announces today. I want to talk a little bit about what the Federal Reserve has been doing. So when we hear these announcements coming out, it'll make sense. But let's look, in fact, here at the last 2 decades. And what we see is that the Federal Reserve has always had what we're graphing here, what we call their balance sheet. But looking back, it just seems so small. But now we just can't believe how big it's gotten. And you see during the Great Recession, that's those gray bars there almost in the middle of the graph, that all of a sudden the Federal Reserve figured out, hey, we can print money electronically, we can print money, and then we can buy stuff with that money. And they bought a number of things, mortgage-backed bonds, treasury bonds and so on, and became the buyer in those markets. The buyer of last resort, as we say. So they really set the price. So this is the government buying bonds from itself. Well, that continued on for nearly a decade for what I would say is no good reason. The Federal Reserve didn't need to be doing that. Now, when the Federal Reserve slows down its bond buying, they call that tapering. And in fact, we're waiting for some tapering news later today, because what you'll see is that they did begin to taper, starting in around 2018, 2019. But there was a little bit of a hiccup in the stock market, and they stopped the taper and they started rebuilding their balance sheet. Nearly a decade after our recovery from a recession, the Federal Reserve had taken it upon itself to be really insurance for all of us as investors, that they weren't going to tolerate even a small downward movement in the stock market. They were going to come to the rescue and send it upwards. Well, look at what they did in their brief 2-month recession. They increased their bond buying significantly, and they continue to do it to this day. So the recession's been over for well more than a year, but they haven't stopped. So what they're doing is they're buying $120 billion worth of bonds with this newly created cash every month. And the word is they may begin to reduce that by $10 or $15 billion per month going forward. We're waiting to see, but there's no good reason that I'm aware of that they should be adding to their balance sheet right now. Another way to measure this, and doesn't this graph look pretty similar, but this is really measuring the outcome of that policy. And this is what we call money supply. There's a few different ways to measure it, and what we're looking at here is what we call M3. But it may really be felt more deeply to all of you if I let you know that if you, for instance, got $100 in your wallet today, 25 of those dollars were born in the last 18 months. That's right, 25% of the entire supply of US dollars across the globe came into being in the last 18 months. The Federal Reserve policy has been so extreme that it has increased by, well, a third from where it was in 18 months, the supply of US dollars. And you can't really bring that back very easily without causing huge disruptions. And so when we've increased the supply of US dollars to that degree, without total production going up, which can't because of supply problems. What are you going to get? You're going to get inflation. And so the Federal Reserve may have given up on this idea that inflation is transitory or temporary. It may finally be sinking in that inflation is taking hold. And if you want to know why, this is the reason why, because of how much money we've printed. So as we go through all these things that are happening, and we've really focused on the monetary side so far, the money supply and interest rates. Take a look here at what we call the risk-free rate. Now, this is the overnight rate that gets paid on money deposits. And I've got 3 circles here to show you what I think has been really a shift in thinking by the government over the last 2 decades. The first circle shows you the response to the tech bubble bursting and this dramatic drop in interest rates there. Not a completely new thing if you look back at the history of this risk-free rate over the last 5 or 6 decades. But then they did it again during the Great Recession and really took them to zero. And then again in the pandemic, took it to zero. So we talk about that as being the risk-free rate, but here's really what they've said. If you want to be an investor that invests safely, we're going to give you 0 return for doing so. Now, you couple that with policies that cause inflation to run at 5 or 6%. What they're really saying is the risk-free rate is a guaranteed loss in your purchasing power of 5 to 6%. Well, that is absolutely terrible for a large number of investors, and it compels us all to want to take risk. And in our case, where we're very calculating about doing that, we've put out the message the stock market is probably the place to be. And in fact, we've got some alternatives to just sitting in cash and public market fixed income, that can do better than this zero. But it's a weird time to be in. And really, this is risk shifting. This is the Federal Reserve giving a boost to everyone that's going to be in the stock market. It's punishing others. So the Federal Reserve has been willing to come to the rescue of stock market investors over and over and over. So if the Federal Reserve is now our insurance policy as investors in the stock market, they've taken the risk off of us and they've put it somewhere. Well, who bears that risk? Well, you could say that it's the people who have cash in the bank. You could say that it's the future investors, the future taxpayers that may have to pay for all this. So if you're on this call, if you're watching this webcast, if you're invested in the stock market and you've stuck to your plan and stayed in through all of this, you've enjoyed enormous returns. Well, that's thanks to the Federal Reserve to a large degree, and them taking the risk off of all of us and putting it on to other people. So I want to extend this concept just a little bit, and I'm not going to spend too much time on this slide, but risk shifting is really the right way to think about all of the arguments that are going on right now, arguments that are not settled about how much more the government is going to spend, what's going to happen with taxes. But whenever the future is in unknown, I think of it as a probability distribution, which is a good way to describe risk rather than an absolute. So to some degree, our society has decided that, we're going to take the risk off of a poor mother who can't afford proper neonatal care, a poor family that can't pay for their children's lunches. By the way, my children's lunches are being paid for in public schools right now, even though obviously I could afford to pay for that. We've got these broad policies that are being enacted to shift the risk. What about the risk that a poor student can't afford to attend college? The idea has been floated that anybody should be able to go to at least a community college for free. What about the risk that the future Social Security recipients won't get the benefits that those folks receiving benefits today are getting, right? Because we're outspending the program's ability to survive. What about the risk that current federal spending won't be covered by current taxes, and in fact, we're putting that bill onto our children and their children to pay for what's going on right now to rescue our stock market portfolio? What about the inflation that's coming out of today's policies? all of the risks are being shifted into the future or onto other people, really for the benefit of, you could say, the economy today, but in particular for the stock market of today. So that's the way I like to think about the arguments that are taking place. And everybody can have their own opinions and should about all of this. Far be it for me to tell you what you should think about it, but I think risk shifting as a concept is a very useful way to understand the policies that are being debated. So here's one more way to think of that, and we may be getting some news any day, although now it appears that even that's going to be delayed. This is your marginal tax brackets. This is how we operate right now in terms of taxes that we're paying on ordinary income. So a lot of risk has been shifted to folks that show a higher income, and this is probably what's going to hit the news if this is changed. Maybe it's some extra charges for folks that are in the top, where rather than raising the actual bracket itself, if you're above a certain income, there's some extra that's added on. A lot of things are being debated, and we'll see. But again, I think that news has probably been delayed, and at least from where we sit right now, we might not get any changes to the 2021 tax code, but this is what's likely to hit the headlines. Just be aware that when it does, there's probably also changes to corporate taxes that are out there. And in fact, some of those, such as eliminating some of the tax havens around the globe, might not be bad policy at all. But just I wanted you to have a slide if you weren't familiar with all the details of the tax bracket. So when any news announcements come out from any kind of legislative compromise agreements, that you know where we are right now. Now, you've noticed that we're shifting away from monetary policy into spending policy here. Let's do that by highlighting the pandemic year. So COVID-19 led us into the pandemic year of 2020. And I just want to educate anyone that's not used to looking at these kinds of charts. But here's what's important. The green is easy to understand. That's revenues. That's the taxes that the government takes in. But the blue wheel is what's a little bit more confusing. And it's broken up here into several parts. And one part is what's called mandatory spending. Now, mandatory sounds like nobody has any choices around that. And to some degree, that's true for many types of decisions that get made. But just notice that the so-called mandatory spending in fiscal year 2020 was $4.6 trillion. That alone was more than the $3.4 trillion that was taken in taxes. So just the mandatory spending was, more than $1 billion higher than what we took in taxes. But then what about the so-called discretionary spending of another $1.6 trillion? Sometimes when you read news articles about fiscal policy, you'll only see the discretionary spending numbers put out there, and that'll be formed into a pie chart and be debated. But it's really the mandatory spending where maybe the biggest cuts are going to have to take place if we were actually going to balance the budget. But the discretionary spending is the Defense Department and many other things that you see outlined there. And those two pieces are really the budget that gets debated if you're reading some of the better news articles out there. What still doesn't get talked about very much is what's in gray, and that's the interest cost, because interest rates are so low right now that the interest cost on our expanding national debt is not all that burdensome. But $345 billion sounds like a lot in absolute terms, but is relatively small in the big picture, only about 5% of total spending. And that's largely driven, as I said, by the interest rates and the fact that the average treasury bond out there matures in just 5 or 6 years. So when interest rates dropped 10 years ago, the cost of the debt dropped, and you just quit reading about the burden of paying the interest cost on our growing debt. Well, as you're about to see, I think that's going to change. As you look at the size of the national debt and what's projected in the future, what you'll see is that we really don't think that it's going to go down. We think it's only going to go up. And honestly, these types of projections, such as what you see here, are framed as a percentage of our economy. So let's assume our economy is going to continue to grow because it's being fed by all the stimulus. That means that the debt as the percentage of the economy is growing, but it doesn't look all that scary. If you just looked at it in terms of absolute dollars, you'd see that it is in fact growing at a pretty rapid clip, because every time we have a year where we, like 2020, where we can't take in enough taxes, we have to borrow that money. Who are we borrowing it from? We're borrowing it from the Federal Reserve, not independent investors, not independent investors out there. But let me tell you why this chart might get a whole lot worse. Let's look at this next slide. And here is a budget that was released by the president. The numbers that are out there are sort of this consensus set of numbers from the government. And if you look at the proposed budget, and it will never be exactly this, what I want you to do is look at the far right column and look at what the interest cost is going to do. Now, we knew it was going to go up anyway, and this has been part of a projection for 10 years that we seem to be heading in this direction, but we've got some hard numbers to it now. Right now, as we said, the interest cost on the debt is only about 5% of the budget for spending, which is way more than we take in taxes. But what's projected here is that 10 years, it's going to be 10. Now, what's the 5% that we're going to take that from? Are we going to take that from defense? Are we going to take that from other parts of the discretionary spending part of the pie chart? Are we going to take that from the mandatory spending, from social programs? Where would that come from? Well, in fact, the plan isn't to do any of that. The plan would be for us to get it from taxes. And so that's why we're predicting that taxes are going to go up. But I want you to notice a column there in the middle that says the interest rate on 10-year treasuries. The rate on 10-year treasuries is typically the rate of expected inflation, and then a little bit more. So that doesn't sound very scientific, but that's kind of the way it works, because that little bit more number goes up and down a bit. Well, right now, inflation is running at 5.9%, according to the cost of living adjustment next year that Social Security recipients are going to receive. So we're projecting here what? That the 10-year treasury is going to go from 1.4 to 2.8. What if the 10-year treasury goes to 7% or 8% or 10%? What if inflation is not transitory and has taken hold because of all of these policies? What if all of us are worried that houses are going to cost more next year and cars are going to cost more next year? Washing machines and dishwashers and refrigerators are going to cost more next year. So we start buying them now, which is what anyone with a paycheck and a hyperinflationary economy has always done. We buy things as soon as you get the cash, right? Because you want to lock in that value. So inflation stimulates this weird kind of self-reinforcing cycle where we all make it worse. We all go buy stuff. We make it worse because that puts extra demand on the supply chain. It moves where supply and demand cross, and it makes prices go up even more, which causes us to exhibit that behavior as consumers even more. So when we look at this chart, we say that's great, but it could be that in 10 years, the 10-year treasury rate is high single digits at least. And then the percent of the budget that's being dedicated to paying interest costs might be what? 20%, 25%? Where's that going to come from? So we don't know. That's the real nightmare scenario that we could be in, is runaway interest costs, something we were exploring decades ago, back when we had an inflation problem then. So that's why inflation is so dangerous when you're running your fiscal policy based on borrowing. So let's talk a little bit with all of those variables out there about the things that we can control. So we do this already, and I just want people to be aware when you're having your meetings with your personal wealth advisor this year and into next year that you might hear these things. First, we really want every one of our investors to have a qualified tax advisor. There's still some pretty smart people that like to do it themselves with TurboTax or other programs. But we prefer for most people to have a qualified tax advisor. You don't necessarily need to have the CPA designation, but to be in the business and to understand some of the ideas that we might put forward so that we can get help running an analysis of what the benefits to you might be. There's issues of income management, and I'll give you an example. Maybe you're not old enough yet to be taking the RMD from your IRA, the required minimum distribution. That got moved to age 72. Recently, but you have a down year with income. Maybe it makes sense to go ahead and pull some money out of your IRA now so that that balance gets shrunk, so that when you have to take the money out of the IRA and maybe your tax bracket is back up, it won't spike the bracket that you get into. Roth conversions are a great idea if you pay some taxes now to convert IRA assets to Roth IRA assets. That Roth IRA income should never be taxed, and you don't have to do a required minimum distribution from the Roth when you turn 72. So it can be a great way to plan for the next generation, or even for yourself. And it would appear that the legislation that might limit Roth IRA conversions is now off the table in the current legislative debate. Obviously, managing capital gains and where we own certain types of investments is something that you're probably familiar with. We've been doing that all along. Some investments ought to be in a taxable account. Some investments ought to be in the IRA if you've got both of those available to you. And then lastly, please update your estate plan. IRAs cannot be handed down to beneficiaries in quite the same way that we could always do that. And honestly, we've still got pretty favorable tax policy around our ability to pass on assets to the next generation. In many cases, the failure to do so is what we would call the voluntary tax. And we doubt that too many of you listening to this want to volunteer to pay extra taxes that could easily be avoided. So here's just the final thoughts to summarize what we've talked about today. For 2021, we've got these 5 key themes that we're sticking to. And the next one that we're going to talk about is going to be the value of adding perhaps more private investments to your portfolio. We do think tax rates were going to increase, but the headlines are evolving on a daily basis. As it stands now, we might not see anything in the remainder of this year, but we don't know for sure. We'll just see. Just don't be too surprised if there are at least some modest increases in taxes. And at this point, maybe most of those are going to be applied to corporations. We'll see. I want to just offer that I say nobody has a plan to balance the budget. Maybe that's a little too extreme, but there's very little energy around the idea of balancing the budget in Congress anymore, because it's pretty much impossible to do. You'd have to get rid of so many programs that we all count on, including defense spending, to get anywhere close to doing that, or you'd have to raise taxes considerably. And what I don't see is anybody that wants to raise taxes by a massive amount and cut the budget by a massive amount, which is about what you'd have to do. And if you're curious how hard all that would be to even work out, there's a number of online simulators that will let you play that as a game to see if you can even come up with a way to do it. I think the current political fighting is about risk shifting, and I hope that that concept is useful to you as you're hearing the political debate. But lastly, let's keep in mind, let's not end on a sour note here. There are a lot of things that you can do, a lot of things we can do for you to help you manage your taxes. And if indeed taxes go up, talk to us. And if you don't already have a qualified tax advisor, maybe we can help you to find one. And let's do what we can to keep you from paying any unnecessary taxes.